Hello and good morning. This is Mark Sobel, U.S. Chair OMFIF. Today, I'm delighted to welcome Ian Coase, Chief Economist and Director of the Prospects Group in the Equitable Growth Finance and Institutions Practice Group of the World Bank. He leads the World Bank's work on global macroeconomic outlook issues, financial flows, and commodity markets, and he oversees the bank's production of its Global Economic Prospects Report. He joined the bank after working at the IMF, including in the Research Department of Multilateral Surveillance Issues. Ian has written extensively on international macroeconomics and finance, including emerging markets, low-income countries, and debt issues. So I'm going to give the floor to Ian for a presentation. I'm likely then to ask him a few questions and then turn it over to the audience. To kick off the audience discussion, I've invited two discussants to lead us. First, Daouda Sembene. Daouda is the founder and CEO of AfriCatalyst, a global development advisory firm in his home country, Senegal. He's a non-resident at the Center for Global Development and served on the staffs of the World Bank and IMF, as well as being the Francophone African Executive Director at the IMF. Second, Magda Poland, Principal and Lead Economist at PGIM Fixed Income, covering the major emerging market economies in Central Europe and the Middle East, and also a senior member of PGIM's Fixed Income's Global Macro Research Team. So, Ian, please lead us off. Over to you. Thank you for joining us today.
Thank you, Mark. It's a great pleasure to be with you and Daouda and Magda to discuss the state of global economy and especially prospects for emerging markets. What I thought I would show a little bit of, the material of how we are thinking about certain risks and how these risks manifest themselves in the context of emerging and developing economies. So very quickly, I'm hoping you can see my slides, Mark.
Yes.
So how do we see emerging and developing economies? I'm going to focus on two questions, and they're both about the possibility of stagflation. The first question, why do we think stagflation is a major risk today? And the second question, what threat does stagflation present for emerging developing economies? Throughout the presentation, I'm going to use this acronym EMDEs that stand for emerging market and developing economies. So the first, let me quickly talk about the state of inflation and growth. Of course, the supply shocks that we had expected to unwind have proved to be much more persistent than what we anticipated. So we ended up with high inflation. The war in Ukraine did not help. In fact, added these inflationary pressures. Now, inflation globally is running at almost 3-decade high. In fact, highest since 1994. In the case of emerging market developing economies, is running 14 years high. And if you look at advanced economies, it's a 4-decade high inflation we are facing. Inflation expectations for this year and next year have increased, as you see in this slide. With respect to growth, we are expecting a sharp downturn this year, and we think that that downturn will continue next year. Emerging market developing economies appears to be resilient when you look at how much growth numbers downgraded in advanced economies, but there are significant challenges there, and we are expecting growth to be weak in those economies as well. This context of rising inflation and declining growth is also reflected in the forecast of consensus. Here I have the consensus forecast for growth and inflation for 2022 on the left and 2023 on the right. When you look at growth, for example, for this year, growth forecast was downgraded from 4.3% to 2.7% from May to August. And for next year, from 3.2% to 2.3% from February to August. So significant downgrades. And when you look at inflation expectations, inflation forecast upgraded for both years. Now, going forward, what do we think that it will happen beyond 2023? With respect to inflation, we expect that inflation to peak this year, especially later this year, and then gradually decline to about 3%, as you see on the left panel. But that still leaves inflation about at least a percentage points higher than what you had over the period 2015-19. So that means there might be, additional tightening coming above and beyond what markets are expecting today. On the right, you see long-term growth expectations. Obviously, potential growth has been declining because of the pandemic. We think that the decline in potential growth is going to be more pronounced throughout the 2020s. And of course, when you look at the long-term growth expectations from the consensus, these are 10 years ahead expectations, those expectations have been downgraded significantly. So what do these all mean? Stagflation is not a term very well defined. If you think of, high inflation and weak growth, obviously we have now inflation above target. Almost all countries around the world, inflation targeting economies, and growth actually below potential, and will be below potential for the foreseeable future. And of course, that means this basic definition of stagflation is there for 2022 and 23. Against this background, there are significant risks confronting emerging market developing economies. I'm not going to get into the details of these risks, but geopolitical tensions are there. Supply disruptions, I think we are reading quite a bit every day, and those supply disruptions are going to be there because of the war, because very tight labor markets. The stagflation risk is material. With that stagflation risk, of course, the higher interest rates could trigger financial stress. And there are many other risks I'm not going to get into. But let me turn to the second question. What threat does stagflation present for emerging market developing economies? And there, the only, I think, reasonable example in history is what happened in the 70s and early 80s. There are some similarities. These similarities are concerning, and there are some differences. So let me briefly talk about that. What are these major similarities? First, as just I mentioned, then and now, there are just large negative supply shocks. Inflation was rising sharply while growth was weak. And that's exactly what you see on the left two panels. From 1970 to 80, inflation averaged around 10%. In 2022, already around 8% at the global level. And when you look at how much growth slowed down following the 1975 global recession, actually the slowdown we are projecting is much steeper than what we had in the in the aftermath of 1975 global recession. Another very important similarity is the accommodative monetary policies that basically preceded the period of the late 80s, late 70s, early 80s, when interest rates were pushed up significantly. So during the past decade, global real interest rate averaged around minus 0.5%, and that's exactly was the case from 1970 to 1980. One other important similarity, how emerging developing economies accumulated debt during the 1970s. There were a variety of reasons, but of course these petrodollars recycling, the negative real interest rates, the syndicated loans, the invention of those instruments, all contributed. But what we had in 2010, just totally remarkable, we saw the fastest, broadest increase in debt levels in emerging market developing economies over the past 50 years. So now, obviously, you can look at history, find similarities, but history does not need to repeat itself, but it might rhyme. So what are the big differences that make us optimistic? The first important difference is how monetary policy frameworks have changed. You have very determined central banks when it comes to price stability. A number of emerging market developing economies also adopted these inflation targeting frameworks. So it's quite a different approach to monetary policy than what we had in the 1970s. There was not a well-defined anchor. There was not a well-defined objective. It was more of stop and go policy implementation. But here we have very determined central banks when it comes to price stability. When you look at the wage growth, one of the important drivers, of course, inflation, that appears to be still more modest than what we had, of course, in the 70s. And another important factor is how flexible the economy is. You can look at the labor market, you can look at the energy efficiency. It's a different world. So this greater economic flexibility allow a faster supply and demand response, especially in sectors where you have significant price pressures. What we need to remember is that how that era of stagflation ended, and of course, that era of stagflation ended with very sharp increases in interest rates in the United States and some other major economies. And those interest rate increases pushed the global economy into a recession in 1982. And we ended up with, around the 1.5% decline in per capita growth. With that global recession, there was a string of debt crises. In fact, when you look at the debt crisis over the past 50 years, you have the highest number of debt crises in the 80s and 90s, and the combined total of debt crisis during that era is larger than the debt crisis we saw in the 70s, 2000s, and 2010s. So what did I say? Why is a stagflation a risk today? Because of the possibility of a protracted period of elevated inflation and weak growth. And the second question I ask, what threat does stagflation present for emerging developing economies? I think when we look at the history, the 70s stagflation ended with a series of financial crises in emerging developing economies. These economies are now facing a rising risk of a similar outcome. I would like to invite everybody to check our publications on these issues. We will soon release a new study looking at the possibility of a global recession, and I hope to have a conversation with you on that, Mark. Let me stop here. Back to you. Thank you.
Thank you for that excellent presentation. Well, let me start off with a few questions, and then I should have said at the outset that after Dauda and Magda speak, we encourage audience to submit questions via the chat function anytime. So we're looking forward to that part of the discussion afterward. Let me just start off with where you ended. So obviously, given U.S. and other countries tightening rates, the Russian invasion of Ukraine, what we've seen in global energy markets, and one thinks back, in my experience, you cited the various decades, but when I think back to the Asia crisis, we saw a systemic contagion. And it seems to me that there are now weak cases out there. I think we know them all: Turkey, Pakistan, Argentina, Sri Lanka, etc. But they're well known to markets. But otherwise, since the Asia crisis, I've noticed that many emerging markets strengthened their resilience. They built up reserves, let their currencies float, better fundamentals, local currency bond markets, etc. And given the enhanced resilience, I've had the feeling that systemic contagion could be possible, as you alluded to at the end, but I actually don't I'm not inclined to expect it. And so when you at the end were discussing that crises could happen, were you thinking a systemic crisis, or are you just thinking a multiple of crises in various low-income countries and frontier economies and some of these countries that really haven't performed all that well?
Thank you, Mark. I think that is one of the million-dollar questions probably we will discuss today. In our baseline, we do not see the type of systemic crisis we had in the early 1980s. That era was really something remarkable. Having said that, one issue we need to keep in mind, how the global landscape has been changing for emerging market developing economies from 2021 to 2022, and then how it might change in 2023. You look at financing conditions, these conditions are getting tighter, significant capital outflows from these economies. You look at global trade, we downgraded our global trade growth forecast, and then we might downgrade even more when we do the next round of forecast. You look at commodity prices, of course, you have really complex dynamics in energy markets, the natural gas prices off the roof. Oil price stabilized a little bit relative to what we had 2-3 months ago. But the metal prices have been in a declining trend, given the weakness in the global economy and prospective weakness I mentioned. And of course, when you look at the agricultural commodity prices as well, there are certain downside pressures. So the external environment is quite difficult. But one important issue for these economies, I mentioned this negative real interest rates they had during the 2010s. In all likelihood, they will not have negative real interest rates going forward. In all likelihood, central banks will push the interest rates to a level. These global borrowing costs in real terms will become positive. I think there we are going to see which countries will have serious rollover problems and which countries will handle the dynamics well. A number of them have already increased interest rates, seeing that inflation going to be a problem. So I am hoping that we will not have a systemic debt crisis in the way in contagion, the type of things we have seen during the Asian financial crisis or in the 80s or 90s. But at the same time, we need to be realistic about the possibility of, a series of crises erupting because of weak growth combined with, very tight financing conditions. But let me stop there.
Thank you. And you have just reminded me of a famous purported saying about the U.S. budget that somebody said decades ago, which was $1 billion here and $1 billion there, and pretty soon you're talking real money. So let me ask you a question about low-income countries. I think I've seen statistics at 60% are in debt distress. The common framework has been adopted to tackle unsustainable debt in low-income countries. Only Chad, Ethiopia, and Zambia signed up. So far, there is no concrete debt deal, though some advances on financing assurances for Chad and Zambia have been made. Reports point to tremendous Chinese foot dragging and private sector in being willing to treat lending, especially with haircuts. Has the common framework been a flop so far, and what needs to be done?
So I think that kind of the first observation I will make about the common framework, Mark, a little bit of progress is better than no progress. So there is a little bit of progress. But what is important is that we need to make sure there is success in these early cases. This will benefit, of course, those countries involved, but also foster confidence in the common framework. The question you are asking is clearly shows that that confidence is not there yet. And we need to see the next steps and serious willingness to address these debt challenges. Not just, these challenges are there. We might have larger challenges down the road, as I mentioned in my presentation. Now, we are hoping the following things going to happen in the context of the common framework, so we will make some serious progress. I think the first thing we need great clarity when it comes to different steps and the timelines in this process. Official creditors need to work with the debtor countries, the sovereigns, and the private creditors to accelerate the decision making. And you know very well, this is much more difficult than said when it comes to practice. Now, the second important issue, we need to really think about how we are going to handle this transition process. Some of these countries are really poor. They need some type of standstill, bridge financing while the process is taking place. So they have debt relief to take care of fundamental necessities they have. And the third, we are expecting common framework really bring a clarity when it comes to this comparability of treatment issue, how that comparability of treatment will be enforced, and in the context of delayed payments. So there is, in a sense, comfort when it comes to creditors as well as debtors. I think the final point I will make, obviously there are huge challenges in the context of common framework, hasn't delivered what it has promised so far. There has been some progress recently. We would like to be optimistic, but there are other highly indebted countries out there. Some of them are not necessarily low-income countries. As we get into this very serious interest rate tightening cycle, we need to be really concerned about not solving these issues in a timely and orderly fashion. And at the end, we will have a snowball problem in our hands next year this time. And we are worried about that problem, Mark. Back to you.
Well, thank you very much for that. So I'm going to ask Dauda and Magda to join us on camera. Again, the audience is welcome to submit questions. Should I start with Dauda or Magda? Dauda, go for it.
All right. Thank you. Thank you very much, Mark. And thank you to OMFIF for inviting us to this very important conversation. And of course, I also thank Ayhan for his very insightful but sobering presentation on the risk of stagflation that we are facing today, but also on how it may present a threat to emerging markets and developing economies. I certainly fully share his perspective in the sense that, of course, there are a lot of similarities in the world that we are living today with the stagflation episode of the 1970s. I think Ayhan is right that among those similarities, we have, of course, the high inflation, but also the weak growth, as well as the accommodative monetary policy, and most importantly, also the high level of debts. But of course, I think also there are what I would call, I guess, some reassuring differences with the 1970s, as Ayhan pointed out. It's the fact that we do have now countries with stronger monetary policy frameworks, as well as actually stronger resilience to wage pressure, but also more flexible labor market. So I think this is actually quite positive. What I would say is, in terms of how this risk of stagflation threaten emerging markets and developing economies. I certainly agree with the fact that this is a real risk, and it certainly has the potential to have an adverse impact on macro stability, financial stability. This is certainly undeniable. But I would actually go beyond a simple historical perspective or comparison with what happened in the 70s and 80s. I would actually dig further when we talk about emerging market. And why I'm saying that is that I think we all agree that there is a lot of heterogeneity among emerging markets and developing economies. The way some of those countries are exposed to the risk of global stagflation is maybe totally different from the way other emerging market and developing economies are exposed. So basically, if we stick to of course, a historical perspective, we might not capture those differences. And there is a need for more granular analysis in my mind to capture those differences. I can give you some example. I think when we talk about emerging market and developing economies, we are talking about a universe of countries with some having access to the markets and others not having access to the global markets. What it means is the way, of course, even though the concerns about capital outflows are certainly legitimate in general when we talk about the emerging market and developing economies, but some actually, that concern is more relevant for some of those countries than others. In the sense that I think, let's assume if you are not necessarily actually, if you don't have access to the global financial market, certainly that risk of capital outflow may be less of an issue for you, although other risks actually that we are associated with the global stagflation may be important to you. So that's one. I think another difference among emerging market and developing economies that we need to be mindful of when we analyze the impact of stagflation is the fact that some of them are also benefiting from the current context in a different way. Let me talk about, for instance, the commodity exporters. You know, when we're talking about this risk of global stagflation, we also have to be mindful of the fact that we are in an environment where there is more and more, commodity prices are increasing very, very fast, like skyrocketing. That may be actually a concern for many countries that are net importers of commodity, or let's say oil, for instance. But it's actually a welcome development for some of those that are exporting. So I think this is also something that we need to be mindful, the type of differences that exist between those emerging market and developing economies. Maybe one issue that is very critical also that I would think that we may look at, and that's one of the differences from the 1970s and 1980s, is the fact that we have a world now where among emerging market and developing economies, there is very significant trade between those countries. And this is a mitigating factor that we need to be mindful of, in the sense that I guess, in the 70s, most of the trade relationship between developing economies were mostly with the advanced economies at that time. And now we see that I think some emerging market countries have gained in importance in terms of trade with other emerging market and developing economies. I can think about China, I can think about India, I can think about Turkey of this world that are actually gaining more and more importance in terms of trade partnership with other developing economies, particularly in Africa. Those are some sort of mitigating factor that actually are positive factor that may sort of help reduce the risk posed by stagflation to emerging market and developing economies in general. So that's really important to look at all of those differences. And my sense is the upcoming World Bank's publication that Ahan talks about could be opportunities to dig further and see how all of these factors may certainly help build resilience in emerging market and developing economies.
Great.
One last comment before I certainly give it back to you is, once we know what's the threat associated with stagflation to emerging market and developing countries, the most important question is how we can build resilience to sort of mitigate that risk. And I think to me, the question that Mark asked about how debt restructuring of the common debt framework could be made more sort of effective, I think this is very relevant, because that certainly would help address the debt vulnerabilities that many developing economies are currently facing. But I think it's one other issue right now that we also need to be mindful, and I'm very much curious to hear from Ayhan about what the World Bank is doing on that front, is how to deal with the energy and food crisis that the world is facing now, particularly the developing economies. What type of multilateral initiative could be sort of implemented to support those countries in addressing those shocks? And I certainly am looking at to hear more about what the World Bank itself is doing or plan to do to support the countries as they face this issue. Thank you.
Great. Okay, I'm going to give it to Magda. Maybe then Ian will have a few words, and then we'll go to the audience. Magda, please.
Yes, thank you. I cannot agree more with on the discussion about the more granular approach towards emerging markets, because putting all these countries together, both the very highly developed upper middle income countries together with the lowest income countries in the world, clearly distorts our perspective and also the risks on policy challenges and risks of a systemic crisis. So let me go back to the starting point of the stagflation and and how the situation resembles the 70s, when we also had a crisis, energy crisis, and overborrowing, a rapid tightening of the US rates. But this was the world of not only much lower financial integration, but also a world of predominantly hard currency debt of emerging markets that then led the US and others to create the new instruments, restructuring, Brady bonds, and so on. Now we have a relatively low role of, now we actually have much more local debt in emerging market countries, especially those middle income countries and those DMs of EMs, as I like to call them, and the higher rated ones. So that poses a very different challenge, which is much more similar to the one that is faced by the developed economies. Higher debt, lower growth, higher inflation, and higher interest rates. It's exactly the same. And the instruments and the challenges that these middle-income countries will have to deal with are much more similar to those of, say, Italy, not even Italy, but the countries with higher debt, rather than those of the lowest income countries that have to deal with multiple crises. And also what is different now, even with, say, comparisons to 2008 and 13, when we had the taper tantrum, is the relatively low role of foreign investors in the local markets, which again brings us closer to the situation in developed market countries, where the challenges that they face is much more similar to those of the DMs. However, the difference is they don't have reserve currencies and they don't have ECB to help. So that's a much harder challenge, but also similar temptations of, say, financial repression or larger involvement of the local central banks in the resolving of these policy challenges. But there's also something when we talk about the going back to the 70s, and we hear quite often that these are really unusual times, because EMs are no stranger to crisis and disruption. They have actually gone through multiple waves, and that forced them to improve their policy quality and credibility of their frameworks. But it is really unusual because also these are really unprecedented times for the developed markets. There was a wave of challenges, but this is really unusual. The global dispersion of inflation, the global energy or food price shock, the greater inflation challenge, oil and gas disruption, and also that fragmentation of global markets and the geopolitical camps that then will force some of the EMs to stand on the side of one or another, with the conflict in Ukraine being yet additional source of that division, and the role of growing role of China and its own ambitions to creating even more of these camps. And also, when we think about it, yes, there is more trade between EMs, but also China became such an important player. And we quite often talk about how China is very important for the EM's current account, so trade and growth, while the US is important for the financial account, which is financing. But China is also becoming now a much more important element of that financing account. And when we talk about resilience and the need for clarity in treatment of investors and debt holders, that becomes such an important picture as well, complicating that what used to be much simpler picture of debt holders of emerging markets to a much more complex one. So we do have that. What it seems is almost an inflection point from those years of stability and improvement in policymaking to one where we have many more players on the international debt side, and that's especially important for low-income countries, and much more of DEM-like challenges for those more developed emerging markets. And we have to think about this because, as I said in the very beginning, and Dawn said that as well, just lumping them together in one basket, one instrument, one asset class, obscures the challenges and obscures the ability to address these policy needs in a more efficient way. We couldn't really talk, me being here in London, about the fact that looking forward, some of these countries do face quite different risks as well, with the energy crisis looming on the horizon here in Europe being especially important for a number of countries. So lack of gas and electricity may be quite important. And this is not local, especially here in Europe. The DMs and EMs are now form one economic organism. So talking about gas shortages in places like Poland or Czech Republic doesn't mean that they remain isolated there. That means that the industrial heartland of Europe suffers, and this will propagate through global production chains, adding to shortages issues. So this makes a huge difference from the crisis of the 70s, but even of the 80s, where the crisis or challenges in an EM might have affected other EMs. This time, this may spread towards the DMs, mostly through the economic linkages, not forgetting the massive presence of developed market companies in emerging markets through FDI. That's also very important. But this is really that real economic integration that makes them so much more important these days. And we need to remember that when thinking about the spread of risk originating from EM to DMs and then from DMs to EMs. Great. Talking about debt risks, just one more comment. Because there's so much local debt on the EM side, we are not really that concerned about immediate risks to solvency. But so those DMs of EMs, the middle income countries, are in our view relatively safe. But really the risk is on those lower income country side. And what Dawn said and Ayhan about support, clarity of restructuring, bridge financing, lending into arrears would be especially important for investors who are present in those markets. Thank you.
Great. I noticed one strong theme is that we all are making the point that you can't view emerging markets and low-income countries as one fell swoop. One needs to really differentiate and treat them as a variegated set of countries. Ayhan, over to you for a few minutes.
Thank you. I greatly appreciate the feedback Doda and Magda provided here, and I agree with them about the need to think these economies with their specific characteristics. There is no question about that, and the challenge here, which ones will be, resilient, and which ones will have greater challenges down the road. With that in mind, let me make two observations. One, I think that the challenge about the slowdown is quite significant, irrespective of emerging market, developing economy you are thinking of. And their arithmetic is very clear. US economy is slowing, Euro area is slowing, China is slowing. So when you bring those three, these are the main engines of the global economy. You have a significant growth problem in your hand. And typically when you have this type of slowdown, policymakers come to the table aggressively, and they provide counter-cyclical support. They are not doing that. In fact, they are doing something quite different. They are going with a pro-cyclical approach. On the part of monetary policy, their message is very clear. They're not going to look at activity. They're going to look at prices, and they are going to try to deliver their price stability mandate. And that is a common shock on the growth side and on the policy side to all emerging developing economies, irrespective of their characteristics. And there are a number of challenges. I think Magna and Dode articulated those challenges we need to think about in the context of specific countries. Some of them have, I think, positives. The second important issue, as much as frameworks, policy frameworks have improved, we see two critical shortcomings still. The first one is there is this possibility of the anchoring inflation expectations in emerging market developing economies. When you look at these inflation surprises, how they affect inflation expectations in these economies, actually the impact is totally different than what you see in advanced economies. Inflation expectations do not respond to surprises in inflation in advanced economies. In emerging market developing economies, sensitivity has declined over time, but that sensitivity is still there. So inflation might come down, but it is not entirely clear whether it will come down so fast in emerging market developing economies as we are hoping to see in advanced economies. I think the second important issue, and this is very critical, we also need to think about the quality of governance. And that one, we should all worry about. And that one is not necessarily about economics, the quality of institutions. When you have institutions having the rule of law, a country is saying on the paper, I am doing inflation targeting, I have an independent central bank, and it does not have that in practice, is a totally different narrative than what we can basically sit down and observe. I think that the emerging developing economies have significant challenges, and I'm happy that both Dode and Magda are realistic about these challenges. About the Dode specific question, there was an institutional question. Let me address that, Mark. The World Bank has significant experience when it comes to food crisis, energy crisis. In fact, Dode and I, we were at the IMF during the previous big food price crisis in 2007-8. At that time, we had at the World Bank this temporary global food crisis response program that's still there, and we have, of course, the global agriculture and food security program already available, and we made $12 billion available to our member countries. This is in addition to close to $19 billion undispersed balances we have in projects related to food and nutrition. So I think we have a sizable war chest to help our member countries, and we are hoping that global community is going to, look at this issue carefully. Most of the time, the food insecurity problem is not just about the price dynamics. It is all about making sure food is available where it is needed. In some other parts of the world, ample food supplies available. We need to make sure we are, taking these supplies to the places that are needed. We have been raising these red flags over the past 18 months with respect to food crisis. It reached to a new level with the invasion of Ukraine, and we are hoping that we will make significant progress during the next 6 months on this issue. Back to you, Mark. Thank you.
Thank you. In listening to this conversation and turning to the audience questions, just let me start off with two that are interrelated. One, So I think we're seeing in the Fed, in the U.S. and Europe, there's a debate between, let's say, hawks and doves about monetary policy, how aggressively to respond, particularly in an environment where a central bank can't do much about energy prices. I guess in the U.S. there's a demand component, in Europe there isn't, but I don't know if you have thoughts on whether, or the World Bank has thoughts on whether maybe some of the rhetoric is too aggressive or not. And then related to that, from the audience is, if you could amplify a bit on the optimal policy mix for EM emerging markets against this background, and maybe something about fiscal role, fiscal policy's role, and if you wish to add on anything on how well emerging markets are prepared to cope with rising interest rates this time, that would be appreciated.
Shall I take it, Mark, or?
Yes.
Okay.
Yes, I'll come back to Duda and Magda at the end, and they can say if you got anything wrong or not.
So in the context of monetary policy, I think that there is not much, advanced economies can do at this point. The last year, we thought that, and I think central bankers around the world, inflation pressures were temporary. And at the beginning of my talk, I mentioned these supply side disturbances. They ended up being much more persistent than what we estimated, and I think what central bankers estimated. Here, there is a serious risk of inflation expectations getting de-anchored, and central bankers have to deliver their fundamental mandate with respect to price stability. So I think the kind of the narrative they have is understandable. They need to show their decisiveness, but at the same time, they are going to look at the data. So far, let's face it, they have not been that lucky in the context of these supply disturbances and how forceful was demand rebound. But they might get lucky in the coming months. There are some tentative signs of supply disruptions moderating a little bit. At the same time, what we see in energy space is not necessarily hopeful. So they need to worry about these second round effects associated with energy prices. And of course, they need to worry about the very tight labor market and the wage price spiral. So, so far, so good in terms of what they are trying to do. When it comes to emerging market developing economies, optimal policy mix starts with having a credible medium-term fiscal program, and making sure that that fiscal program is very well articulated and calibrated as it is implemented. In some countries, we already saw medium-term fiscal programs were announced, and the markets were not necessarily convinced about the ability of these governments to implement the medium-term fiscal programs or the credibility of medium-term fiscal programs themselves. On the monetary policy side, I think, as I mentioned before, the policymakers put a lot of emphasis on tightening the policy, getting ahead of inflation expectations. They know that it is much easier, these expectations getting the anchor in emerging developing economies. So they need to be decisive going forward as well. I think this credibility, calibration, and communication of policies going to be critical. And then financial sector policies, when it comes to, monitoring the banking sector risk, monitoring the kind of the risk associated with certain segments of the market. Sovereign debt has increased, but the increase in private debt in emerging market developing economies is much larger. So we might end up at a state of affairs, this private debt suddenly migrates to public balance sheets, and you have other challenges. I can talk more, but I would like to make sure Dodd and Magda can provide interventions. Back to you. Thank you.
So I'm going to ask you one wonky question, and then I'm going to turn it over to Dauda and Magda for a last comment, and then we'll wrap up at 11 o'clock, hopefully. The wonky question is that many analysts worry about volatile capital outflow from emerging markets, and they say that this may necessitate more foreign exchange intervention or capital controls. Of course, capital controls shouldn't substitute for warranted macro adjustment, but there have been strong capital outflows, much from China, but also from other emerging markets more generally. So how do recent emerging market capital flow developments affect your thinking about these arguments, which are prevalent in the IMF, about increased foreign exchange market intervention and capital flow measures?
Yeah, so this is an issue. It's not a fringe issue. It's not a wonky issue. The really kind of a serious problem. Obviously, dollar has appreciated sharply against many currencies since the beginning of the year. And then this has been accompanied with very large capital outflows that we are all following very closely. And some countries have been intervening, drawing down their foreign exchange reserves, and we are actually following those developments as well. Now, what we know is that we always need to think about whether this is a kind of a temporary development or it's a reflection of a fundamental challenge. If it's a reflection of a fundamental challenge, Mark, underlying fundamentals of an economy not strong enough, there is constant bleeding, then you can intervene and really draw down your reserves. You can introduce capital flow measures as well, but we know that these things are not a panacea. They're just temporary measures. They will come and go. And in the meantime, basically, these countries will lose significant amount of reserves they need. At the end of the day, I think that there is space for a wide menu of interventions. Capital flow management measures, the exchange rate interventions, they all have places. And as a policymaker, you would like to have them under your disposal. But unless you have large temporary outflows, you would like to make sure you are employing these types of measures sparingly. You can try to forestall immediate economic disruptions, but we know that we are not there yet in many of these countries. The fact that they are using their ammunition is not necessarily a good sign in light of the expectations of even tighter conditions, expectations of even weaker growth. So they need to find ways to expand their reserve buffers and really address the kind of the fundamental credibility challenge and the fundamental structural shortcomings when it comes to policy and when it comes to implementation of policy. But let me stop there. Thank you.
Great. Okay, I'm going to give Magda and Dauda no more than 2 minutes, hopefully one, to wrap up and say anything. I'm going to reverse order, start with Magda this time.
Thank you. So I think that brings us to a very good point, that the boring point that economists always repeat, that fundamentals matter. And they matter for both the moments of stability. They matter when you have a moment of crisis to reduce the outflow of foreign capital, but also they matter for the locals. They matter for the trust of your own citizens who may want to vote with their local currency and prefer to go into a dollar or the euro. So it's not just about foreign investors. It's about the overall credibility of policy for anybody who's active in the economy. But it's good that we have that discussion about these temporary tools. We have the discussion about some form of capital control or the benefits and cost of completely unbridled capital flows. because there are massive positives from that, but the costs are there as well. So having a more balanced approach is beneficial, especially when we think about how economies can handle moments of extreme stress while being small, open economies, and then dealing with, say, maybe some excessive inflows in the past. Thanks.
Dauda, the last word.
Well, thank you, Mark. And actually, I want to come back quickly to the question that you asked Ehan about the common debt framework. I certainly agree with what Ehan said about the fact that there is a need for a greater clarity on the timelines involved in the process. There is a need for also to involve both officials and private sector creditors. That's important. He also mentioned, and I fully agree with him, there is a need for countries that actually apply for the framework to be able to benefit from some sort of a 10% standstill during that the process. And certainly those are actually, suggestions that are very good and that are agreeable. Now the question is how to make it actually happen. And we certainly expect the World Bank, but also the G20 and, to work with borrowing countries to make sure that this is actually implemented in a way that would allow countries that are really in debt distress or in high risk of debt distress to have ways to solve their solvency issues as soon as possible. So there is a need really to translate word into concrete actions. And I certainly look forward to hearing more from the World Bank and other partners. Thank you.
Well, thank you. I should note that during this session today, the rain has left Washington and the sun has just come out. So everything's looking up. I want to thank Ian Kos for leading this wonderful discussion today. It's very informative and insightful. We learned greatly from it. And I thank Dauda and Magda for joining us as well and offering such wonderful perspectives and enriching the discussion. So thank you to the audience as well for joining us. And I wish everybody a good day wherever they are. Thank you.
Thank you.
Thank you, Mark.
Thank you.
Very much.
See you.